Well, it's a higher yield because basically this is old data and old news. The market this morning, at least, is really concentrating on where is oil today, right? And oil's up a couple of bucks at the moment because of the strikes overnight by the US. So people are looking through this data, and obviously there's also so much data to digest here that we're all like quite full right now. So we're trying to parse out what's the most important bits of this. And you noted, Tom, that the spending being flat month on month is actually, excuse me, the income being flat month on month actually is not very good because now we have negative income in large part, it could drive the economy. A little bit weaker, and along with the weaker than expected GDP number for the first quarter, that's not necessarily a particularly good sign, even though the inflation data was a little bit better than expected.
So just the headline, I'm a headline kind of person. Ira, you're the one that digs 27 layers deep. But the headline annualized 3.8% PCE price index. I mean, that's got to get the attention of folks, not just at the Fed, but I don't know, around Washington and policymakers and things like that. What's a 3.8% number mean to you?
Yeah, well, it means for one thing that it's going to be really difficult for Kevin Warsh to lower interest rates, right? Like, how can you lower interest rates when, not only are you running above target in terms of your favored inflation measure. So even if you trim out some of the details of this, and we haven't been able to do that yet because it's obviously the number just came out, but even if you trim it out, you're still going to be above the 2% target that the Fed set. So it's going to be hard for Kevin Warsh to convince other members of the Fed to even think about cutting interest rates. I think for now, when it comes to at least interest rate policy, you're more likely to see the Fed on hold until and unless, one, the war ends, and then
Yeah.
two, if there's major changes to the employment situation, which, obviously we'll get more of that next week.
This wall of data, and as I said before, folks, I mean, there's a dynamic here to nominal GDP in its new territory. For Chairman Warsh, Ira Jersey, do you have an historic analog he can plug in, or is he in new territory?
I think in many respects he's in new territory because even though, like you could argue, and some people have argued that we're moving toward a stagflationary type environment because real growth should slow, given that you might have a lot more of people's spending having to go to fuels and gasoline. But then people then talk about electrification, and then we're not talking about 10% inflation rates like we had back in the 1970s and early 80s. We're talking more about 3 or 4% inflation, right? Which historically speaking, when you go back even to earlier in my career, go back 30 years when I started in this business, we were talking about 2.8%, 3% in PCE deflator. That was fine and that was normal, right? So that is more sustainable, right? Inflation like we have today is somewhat more sustainable than inflation at 9 or 10% like we had a few years ago, just because at least over the last few years, you've seen wages growing at 4%. So that means you still had real wages going up, which is the reason why that personal income number I think is a little bit disturbing to me, and I want to dig into that a little bit more because if we do have negative real wages, that's when you wind up seeing a pretty aggressive slowing in the economy on a forward basis. And so we want to see, is this the start of a trend, or is this just like a one-off measure because Social Security payments were delayed or something like that? So we have to dig into the details of some of this. So Unfortunately, Paul, I do have to dig into those details to be able to get you more information.
Again, I'm not a details guy. I'm right on the surface, but I see personal income flat. I see my GDP number come in below expectations.
Okay,
that feels like stagflation.
This is brilliant, Paul. Ira, all of us think like Paul. It's ugly out there. Does the bond market signal that?
The bond market's signaling that it's really worried about inflation, right? So when you look at like that 2-year yield, which we talk about being very sensitive to policy rates, and of course it is, but when you look at what sold off and why it sold off so much, it's also because inflation expectations in the short term have really gone up pretty significantly. They've gone up 40-ish basis points in terms of the 2-year tips break even. So if we wind up getting a situation where oil gets back down sustainably to $80 a barrel, you can wind up seeing 2-year yields get back to kind of where the Fed funds rate is right now. Will we get down below that? I doubt it because the market's still going to price for the Fed to be on hold probably for a pretty long period of time. But you can easily get a 30 basis point rally on inflation expectations going down. Now, the long end of the curve is not only worried about inflation, and in fact, inflation expectations longer term have barely moved. It's that what's going on with the fiscal situation. Will budgets globally wind up getting even worse because of either defense spending or social spending to kind of combat people having to spend more on energy? And that's one of the reasons why you've seen this global bond sell-off. So, we talk about US 30-year being over 5%. Sure, it is, but this really is a global phenomenon. You look at Japan with, interest rates that haven't been this high in decades. The UK is still having some of its own fiscal problems. So you wind up seeing all government bond yields go up. And one of the triggers for that, obviously, was the war in Iran. But I don't see what makes yields go down quickly over the next couple of months in the long end of the curve in particular.